All right, so private credit. So in my role as a portfolio manager, but also because I have this title, head of research, that one of the implications of that is that I get pitched a lot because people, I guess, look through a website or whatever and decide that I'm the guy to pitch their product to if they want to get it on our.
That explains why you get so few pitches now. They're going right to you, which is awesome.
Yeah, makes me want to change my title. But like I said in the introduction, private credit is by far, like by a long way, the asset class that I've been pitched on the most in the last couple of years. So what is private credit? It's loans, kind of like bonds. Like a bond is a loan, but in the case of private credit, they're not publicly traded, not created by banks. Are created by non-bank entities like a private credit fund or a business development company to fund private businesses. So kind of like the name implies, sort of like bonds, but in private markets, and also sort of not like bonds, which we'll talk about. Now, this asset class gets promoted to retail investors and other investors for its high yields. You'll see, 9% yield and stable returns. And that's the part that I have more of a problem with. But as you can probably guess, I'm skeptical of the asset class.
And it's pretty new, is it not, that it's being opened up to retail, right? I think for a long, it's new to the retail class. It's not a new asset class necessarily, but the proliferation of publicly available funds and institutions that are offering it now is growing very rapidly. And I think that's obviously why we're here talking about it today. It's because it's growing fast.
Yep.
And it's getting some validation. Like I listened to a Prof G interview as well as Damodaran, the valuation expert from NYU Stern. And he was talking about it on this week's podcast, that he's actually looking at credit, and he's a long, devoted equity-only investor. So you start hearing more and more in other types of channels.
Yep. And it's not a bad asset class. Like, I don't want to be the guy out here disagreeing with Damodaran. It's just, I think you got to look at what are you actually getting. And if you're Damodaran, maybe you can find good opportunities in the asset class, but in aggregate is what I want to talk about, whether there's anything special there. Now, this is one of the fastest growing asset classes. I think in terms of growth in like total AUM, private equity is the fastest growing. Private credit is in second place.
Incredible.
Yeah. Papers that I've read on why that's happening, I mean, it's kind of intuitive when you hear it, but that growth has largely been driven by investor demand for high floating rate yields, because we've been through this long period of low interest rates, although they've come up now, but we went through a period of low interest rates, and then people were worried about rising rates. So private credit tends to be floating rate, which protects you a little bit from rising rates, and it's got higher yields than publicly traded fixed income. So that's one side of it. And then the other side of it is tightened capital requirements for banks, which pushed small and mid-sized companies to find alternative non-bank sources of credit. So those two things happened in the last 20 or so years, became increasingly prominent factors. And that is what I have seen argued anyway as the reasons explaining a lot of this growth. So we've got investors seeking yield, and then companies needing non-bank lending, and then boom, we get this big, fast-growing new asset class. Now, within private credit, the fastest growing part of that market is private credit funds. So these are funds that raise money from investors and then make direct loans to private firms. Typically firms, and this is important, that can't get bank loans due to their creditworthiness. Now, another interesting point, and I've seen this as an argument for why this is an interesting asset class, and we'll get to that, to whether or not it does make it interesting. But one of the arguments is that loan terms are negotiated individually with each borrower, and the terms often contain features that traditional fixed income would not, like a structured equity component, like warrants or something like that, as part of the overall deal.
And warrants are they not like a long-term call option in a way?
Sort of like that. It gives you a version of equity exposure.
Yeah.
In the borrower. Now, an important thing, and this shows up in the high yields, the interest rates on these loans are high. The borrowers are too risky for banks, which means that the loans already command a higher interest rate. But then the other thing is that private credit funds have to build their own fees into the rate that they're charging these borrowers, and their fees are high.
I was going to say.
Yeah. So a typical fee structure is 1.5. I've seen 1.25 as low as 1.25. I have not seen lower, although I haven't surveyed the whole market. That's just my casual observation. So call it 1.25 to 1.5% plus a performance fee of 15 to 20% over a hurdle. So all in, it ends up being 3 to 4% in total fees that you would expect to pay, and that ends up getting reflected in the pricing of the loans. So
that performance fee is widespread in private credit?
From what I've seen, yeah.
Interesting.
Yeah. So you take those two pieces. We're lending to higher risk borrowers in the first place. There's equity-like features in the loans. I think private credit, and I don't just think this is what the data suggests, private credit can start to look a lot more equity-like, or at least have a meaningful equity component than bond-like. But the tricky thing is that due to its nature as a private asset class, that equity-like risk is not going to show up as volatility. So on paper or in a pitch deck, the result is what looks like high returns, low risk, and low correlations to public assets, like public stocks and bonds, for example. Now, of course, all of those things, if you can get them, if you can get an asset with high returns, low risk, and low correlations, that is the holy grail of portfolio management. Everybody wants that, right? But of course, private loans are not valued daily. They don't have a secondary market to establish a price. So their reported returns are not always going to reflect the true volatility in the price of the underlying, in the value of the underlying assets. The price is what you see. The value is a different thing.
Who values them? Like in a credit fund?
It would be similar to private equity. I don't know the exact details, but I'm sure they would have some third-party valuation, which is fine. But we'll talk about some of the research on the relationship between net asset value of private loans and market value of private loans.
Yeah.
There's some really interesting research on that.
I saw an article somewhat recently, like in the past few months, it was arguing about valuations on private credit. And I guess they had different evaluators looking at the same, not a bond, but the same loan. And there was no agreement on what the actual value was, because I guess measuring the risk and the creditworthiness of the issuer is a challenge. So you had different shops evaluating it at 75 cents on the dollar, 50 cents on the dollar, 82 cents on the dollar. So without market pricing, you're just accepting the valuations that are being given to you by whoever's evaluating it for the fund.
Yeah. I think I saw that. I think I saw that article too. Yeah. So we don't have market pricing. If you took all of the private valuations, like you were just talking about, Mark, if you took all of them together, you might get something like a market price. But I don't think that the private credit funds are usually doing that. When private credit assets are marked down, and this part's important, and there's some of the research we're going to talk about is on this, the marks down will tend to be a lot more muted. They won't be as deep. They won't be marked down as much compared to an otherwise comparable publicly traded asset. So that again becomes really important when you're looking at these things and asking questions like, what is the volatility? What is the downside risk? What is the risk more generally speaking? So that's super important. The smoothing effect is similar to what we talk about with private equity. But you take return smoothing and generous valuations, especially during bad times on private loans, and it can make the asset class look a lot more attractive than it is, maybe if risk is evaluated properly, if we can call it that. So all this kind of starts to touch on the question that I think every investor should be asking before allocating to an asset class, which is what underlying risks, what economic risks am I taking, and how do I expect to be compensated for those risks? we know about like systematic and non-systematic risk. If you own an individual stock, you're taking stock-specific risk. So you've got to know, what risks am I taking? In the case of private credit, a fundamental truth is that financial assets represent discounted future cash flows. The value of a financial asset is going to change when one of those two things changes. Discount rates can change, cash flow expectations can change. That's why we see price variation day to day in financial markets when assets are valued by the market. That's always true. The value will change. But in the case of something like private markets, we don't have live valuations and we don't have market valuations. Even if you had a private valuation, like you talked about earlier, Mark, even if you did get a private valuation every day, that's not going to represent the value that you could sell it for if you went to the market.
Yeah.
So one really interesting perspective on this that I found in a paper in the Financial Analyst Journal titled Direct Lending Returns, this 2023 paper. They look at publicly listed business development companies, BDCs. These are closed-end funds that engage in direct lending, and they themselves trade on the public market. It ends up being a really cool laboratory, and I'll explain why. So they're relevant to private credit because they're required to invest at least 70% of their assets in non-public equity and debt of U.S. corporations. And they've been shown in other research to be good benchmarks for the returns of private credit funds. So a decent proxy for private credit. So in the paper, what they do to evaluate BDC performance is they build a benchmark consisting of small cap value stocks and leveraged loans because those public assets end up explaining most of the variation in BDC returns. So they take some public assets and they just did this empirically. Like they looked at what package of public assets are representative of the returns of BDCs. And so they found this mix of small cap value stocks and leveraged loans, which are both publicly traded and kind of mirror the returns of the publicly traded BDCs. So that equity bond mix as a benchmark is quite important. And there's another paper on this that we're going to talk about in a little bit. So this is the important part of this paper. They find that when BDC performance is evaluated based on net asset values, and this, Mark, to your earlier point, is when they're valuing the assets themselves. It's like the on-paper valuation when they do their regulatory filings, not
the market
valuation.
prices, right?
Correct. So measured from net asset values, BDCs outperform the liquid benchmarks by 2.74 percentage points per year, and they have very high Sharpe ratios. So that looks really good. It looks like what we talked about earlier as the sort of pitch of private credit. It looks like you can take risks similar to publicly listed assets, similar to risky stocks and bonds, while earning a big alpha.
Is that before any fees are considered?
This is the net return of this security.
Okay. So it'd be after the fees of that security.
Yep.
Okay.
Yep. But then, of course, the issue is that BDCs don't trade at their net asset values, particularly during times of market stress. They'll tend to trade at a discount. And we know the market is this pretty efficient pricing machine. It's taking in lots of information and outputting a price. And so you can kind of think that when the market assigns a price below the reported net asset value, we could take that as meaning that the net asset value was not accurate. You could also take it as meaning the market price is not accurate. You could say the market overreacts.
That's the argument, right? Is the market is irrational. The market underprices and overprices stuff all the time, and our valuation is more accurate. And you get that in all private asset spaces, right? Like private real estate, private equity, and obviously private credit as well. So either the market's wrong or the firm who's evaluating the price is wrong.
And there could be some validity to that. I would tend to trust market prices more. I think from an investor psychology perspective, one of the most interesting aspects of private equity and private credit is that it allows investors to take more risk and have higher expected returns, even net of fees, while feeling like they're taking less risk. There's a paper from Antti Ilmanen talking about how the premium for illiquid assets may be negative. You'd expect to earn a premium for holding illiquid assets because they're riskier, but he's argued that it may actually be a negative premium because people have a high demand for the smoothing effects of illiquid assets.
Mm-hmm.
So it's not obvious that there's a benefit to holding illiquid assets from a financial perspective, but from a behavior perspective, there could be, which would actually drive down the expected returns of the assets anyway.
Exactly. No, it's interesting. I was talking to a friend of mine who works for a firm that does a lot of private assets like private equity, private real estate, and private credit. And we were just chatting yesterday about it. And he was talking specifically about those behavioral benefits for retirees and the psychological comfort they get from withdrawing from a portfolio that looks very stable on the surface, right? And you pointed out the high Sharpe ratios and the lack of volatility. And that's really, as I think Cliff Asness would say, volatility laundering. They're just not pricing it frequently, and it's not being priced by the market in aggregate, right? But there may be a behavioral benefit to that, and I could see that for somebody retiring and drawing from a portfolio.
Yeah, and it's, you know what? It's not a crazy argument. It's not.
No, I don't disagree.
Yeah, and even like you look at private equity and you look at private credit, net of fees, we can make the argument that the returns are not better than public assets, but they're also not terribly worse. I think the bigger issue you have to deal with in private markets is dispersion, where the difference between picking a bad manager and picking a good manager is huge. And it's not so easy to just buy an index fund like we talk about with public markets. So there's that dispersion piece can really hurt you or help you, depending on whether you pick a good fund or not. But if we just look in aggregate, like, I don't know, man, net of fees, the performance is, sure, say it's the same as public assets. So there's no benefit financially to owning these things. But if you get a big behavioral alpha from smoothing, I mean, who are we to say it's a bad idea?
And some cool stories to tell.
Yeah, that's also true.
This is all before tax too, right? So presumably private credit is taxed as interest income primarily.
I would assume so, but that's not something that I've looked into in any detail.
Yeah.
But that would make sense.
Yeah, so on an after-tax basis, depending on the situation, of course, and whether you're holding it in a non-registered or a corporate account, or you might get equity-like returns gross of tax, but net of tax would probably be significantly worse.
That's a good point. Okay, so back to BDCs. We talked about how on a net asset value basis, they outperform the liquid benchmark. On a market value basis, because remember, we're talking about securities that are publicly traded. We've talked about their net asset values, which are the reported asset values, which is kind of like what you would get with a unlisted private credit. But in this case, we get this additional layer of insight because these securities actually do trade in the public markets. Using their market value, the BDCs do not outperform the liquid benchmark. So that suggests that when they're properly benchmarked and properly priced, the apparent excess risk-adjusted returns goes away, at least in the case of BDCs. Although we're going to talk about private credit funds in a second, private credit funds specifically. So there's a 2024, it's a pretty new paper, titled, it's a working paper. The other one was published in the Financial Analyst Journal. This one is a working paper. This one's called Risk Adjusting the Returns of Private Credit Funds. And so what they do is they apply a cash flow based method to form a replicating portfolio that mimics the risk profiles of a large sample of private credit funds. Roughly similar to what we just talked about. They're looking at the private credit funds and figuring out which public assets they can use to benchmark. And they find using an equity and debt benchmark to measure risk that a typical private debt fund produces an insignificant abnormal return to its investors. So again, back to the idea, if we properly measure risk, there's nothing really special going on here. So that means that investors are not getting any alpha. They're just getting compensation for the risk that they're taking in the funds. Their risk-adjusted excess return is indistinguishable from zero. Now, they do note in this paper that if you remove equity from the benchmarks, private credit looks really good. So if you benchmark private credit against public fixed income, it looks very attractive. So I think that highlights the importance of proper benchmarking. It also suggests that anyone adding private credit to their portfolio as part of their fixed income allocation may really just be increasing their overall equity exposure while feeling good about it, which, like we talked about earlier, maybe that's fine. I mean, I don't know.
Well, and this is similar to other corporate bonds, is it not? Where there is some equity risk in the issuer, right? And so
I think it's a little bit more explicit in this case because of the structured equity component to the loan contracts. But yeah, if you go into high yield, it'll start to look like there's equity exposure in there as well, or at least it's more.
It's completely unreasonable to not have some equity exposure in the benchmark, then, is it not?
I would argue so. Yeah.
But people are using this. People are probably using this as a bond alternative, right? And so
that I'm not sure about. I'd have to survey people, I guess, that do this. But if they are, they're taking more risk than they realize.
Exactly.
Like you wouldn't substitute this for bonds unless your intention was to increase the amount of risk that you're taking.
But given how many retail investors are getting interested and how easy it is for them to access it now, and they're seeing it as stable fixed income allocation in their portfolio, to your point, many of them are likely taking a lot more risk than they thought they were. And just replacing this with like their bond allocation with something like this is significantly different than what they thought they were doing, potentially.
That would be my hunch. It's only a hunch, but that would be my hunch. And that's one of the reasons that I think this is an important topic, because there are firms in Canada that very explicitly target low investable asset retail investors who are marketing this fairly aggressively, I would say, in terms of just showing off the high yield and the stability. So I mean, it's not like it's not affecting anybody, and it's not like it's only being pitched to ultra high net worth investors who can afford to take a little bit more risk than they maybe realize that they're taking.
So there's no free lunch.
Well, there's no free lunch is what the research that we're talking about suggests. Now, we also know that in theory, skilled fund managers will attract assets to their fund up to the point where they're no longer able to generate excess risk-adjusted returns. So none of this stuff should be too surprising. And that's Burke and Van Binsbergen, who we had on, I don't remember which episode, 200 and something. But they Jonathan Burke had the original theory on this in the Burke and Green 2004 paper, and then Burke and Van Binsbergen have continued to develop it. But basically, assets will flow into managers up to the point where all of the benefits of their skill are absorbed by the manager in the fees that they collect, and the investors in their funds earn returns that are in line with the risk that they're taking. Episode
220.
220. That was a great episode. But the argument there is basically that there's an efficient market for manager skill. Some research on private equity. This is a paper from Ludovic Phalippou, who we also had on to talk about private equity. His paper has a cheeky title where he refers to private equity as the billionaire factory, because private equity managers generate large fees for themselves while delivering net returns that are similar to public equities to their end investors, which is exactly what you'd expect in an efficient market for skill. And it's important here because this means that there's nothing wrong with the opposite. Private equity and private credit managers are extremely skilled because they're able to earn net returns that are in line with the amount of risk they're taking while charging 4%, or in the case of private equity, 6% total fees. So that's a lot of alpha to generate. But the problem is it gets absorbed by the size of the fund and accrues to the manager, not to the investors. The investors just get the expected return in line with the risk that they're taking.
Ludovic Phalippou was episode 210.
Yeah, that's another good one. So I think in the case of private credit funds, it looks like the managers are able to apply their skill in identifying, negotiating, monitoring private loans. Like, this is no joke. This is serious due diligence. And they're working with companies that couldn't otherwise raise financing. Like, it's all impressive, and I'm sure the people running these funds are absolutely brilliant. But the thing is, they charge a fee rate. They charge a lending rate, to the borrowers that approximately equals the risk-adjusted borrowing rate for them, plus the fees that the private credit fund is charging. And in the end, for the end investors, and in line with what theory would predict, the fund managers absorb the benefits of their skill as fees, and the end investors, as I've said a couple times now, end up taking a whole bunch of risk in this case, probably more than they realized, paying high fees, which maybe that's not so bad if you're getting a net return that matches public markets with lower fees, I guess. But the big piece is they're getting returns that they could get much cheaper, and something we haven't mentioned yet, with better liquidity if they just use publicly listed assets. So I think it's perfectly fine. We've said this a couple of times now. If investors are fully aware of a lot of the stuff that we've talked about, and they go into private credit anyway, they say, yep, I get all this. I get that I could replicate it with public assets, but I want private credit because it feels good, or it lets me take more risk without seeing volatility, or I can tell my friends about it or whatever. I think that's fine. I think the problem is when we have high fee investment products being marketed as safe and stable while having high expected returns. I don't love that. I think that there's probably cases, and this again is just my guess, I don't have data for it, but there are probably cases where retail investors probably don't have the tools or the knowledge to evaluate the risks that they're taking in products like this. And even not even just retail. Like, I've talked to investment professionals who pitch private credit using stuff like the Sharpe ratio or using mean variance optimization routines. I had one person, I don't even feel bad saying this because it was so ridiculous. I had one person, a professional, scold me. Like, it was like he was like trying to mentor me on this, that I should be using private credit because look at when you run an optimization. Look how high the optimizer says the allocation to private credit should be. And the optimization routines are based on expected returns, correlations, standard deviations, all of which are probably not representative when we're dealing with private assets like this.
Here we go.
They also told me about the Sharpe ratio. Look at the Sharpe ratio in this fund. And like, I would argue that that's irrelevant, or at least needs to be taken with a big grain of salt, or you need to use an adjusted Sharpe ratio that accounts for like de-smoothing of returns and other unique characteristics.
I just tweeted this morning that the Sharpe ratio on my house is like 37.
I saw that tweet before you started.
just insane. Like, of course, there's zero volatility. There's no market for it. The only way I know what it's worth is if I look at like the BC assessment they send me, and that's just a tax notice more than anything, right? So there's zero volatility, and it just keeps going up in value. So to your point, I don't think the Sharpe ratio is exactly useful in an asset that by design has no volatility, right?
So how does the conversation go, Ben, with the promoter?
Well, in that case, it was a third-party consultant, not a promoter. I mean, it didn't go very well. They thought I was, a fool because I didn't understand the benefits of private credit, and like we weren't gonna come to an agreement on that. But like, as soon as you're putting illiquid assets into a portfolio optimizer and looking at the 30% allocation that it spits out as optimal, and then saying, "Yep, I'm gonna do that," it's like, gonna give your head a shake, I think. And to Mark's point about the house, just using volatility as a measure for risk when an asset class is valued irregularly or not valued at all and not market tested on the valuations, like, of course that's going to lead to incorrect conclusions about risk and expected returns and how the asset fits into a portfolio. And illiquidity. So we mentioned that briefly. Illiquidity is not great under any circumstances. There is a theoretical case, we talked about this briefly earlier, that illiquidity commands a higher premium, and that's one of the arguments that I've seen for private credit having higher expected returns. But there's also the theoretical case that the premium is actually negative because people are willing to overpay for the smoothing effect of illiquid assets. So I don't know how obvious it is that illiquidity is a benefit, although I've seen it pitched that way in the case of private credit. So I think for most retail investors, allocating to private credit is going to get you, for sure, high fees. It's going to make it hard to evaluate how much risk you're taking and what kind of risk you're taking. And it's going to come with illiquidity. And in return for those generally unfavorable characteristics, I have not seen evidence of a compensating excess risk-adjusted return when properly benchmarked and measured, which is not necessarily easy to do. And then the reason in the research that I've read is that any excess return gets absorbed by manager fees. which is not surprising because that's what you'd expect in an efficient market for manager skill.
Fascinating. So presumably, if the fees were low enough, then this would be interesting. But there's just
so that's an interesting point. I've thought about this. If we say now dispersion is still a problem, like there's so much dispersion in private manager returns that you're still taking quite a bit of I think uncompensated risk there. But dispersion aside, say you could access the private credit asset class as a whole and not worry about dispersion. If most people are paying 4% fees in total and excess risk adjusted returns are zero, if you can get into the asset class as a whole for 2% fees, I mean, I think that's actually kind of good. Like you do expect a little bit of excess return in that case, but it's not so easy to solve for dispersion. And you start thinking about that. Okay, so how would you actually do that? How would you get low fees? You'd have to go in with scale, or know someone maybe, but you'd have to go in probably with scale. Now, if you go in with scale, it might be harder to have full access to the asset class, because to go on a scale, you have to go in with all the managers to avoid the issues with dispersion. So you have to have a lot of capital. I don't know. It's not obvious to me how you'd make that work.
Yeah, interesting.
So I don't know. We don't touch it. So the people who keep pitching me, you can stop.
Same, please and thank you.
Probably won't use it, but is there a place for it? I mean, like we said earlier, it's hard to say any asset class is objectively dumb when a lot of people invest in it. That doesn't mean that investors are always smart, but people demand exposure to asset classes for some reason. There's some amount of revealed preference in demand for asset classes. And that can be a lot of stuff that we would say is dumb, like demand for thematic ETFs. Is there an argument that that's intelligent in any way? Probably not. But are people getting something out of it? Clearly. Clearly they are. Otherwise they wouldn't keep buying them again and again.
Are you doing a YouTube video on this as well?
Yep, I will.
Great. Look forward to that. Anything else? You want to go to the after show?
I don't have anything else to add. Mark?
No, that was good. It's very fascinating. It's not something I've spent a lot of time with, so it's very enlightening for me. It's great.
I'll be curious on people's thoughts. Like if people hear what I said and think I'm missing something, happy to hear it, because I've talked to a lot of very smart people and people that I respect who have said you got to look at private credit as it's a real thing with real opportunities. And I'm sure that's true at some level, but I find it hard to get away from the economic logic that you're still taking risk, even if you don't see it. And when that risk is properly benchmarked, it doesn't seem like there's a whole lot of a free lunch, which again is what you'd expect, especially with an asset class that's growing and has reached a level of scale that this one has. You can find, like, you got to find the next big thing. You know what I mean? Yeah. Before it's big, if you want to get excess returns.
I mean, even at its most like basic level, because people like on Twitter or whatever will ask me about this stuff all the time, and they'll show me a credit fund, and like you said, there's almost zero volatility, consistent payouts, right? And it looks like a money market fund on the surface. But if the rates are that high, if the expected return is that high, you must be taking risk there, right? I mean, if you look at whatever the risk-free rate is, and this is paying 5% higher than the risk-free rate, like, especially when it comes to fixed income, it becomes very obvious. Who's going to borrow as a firm at 10, 12, 14%? To your point earlier, if they could just go to the bank and get a loan at 4 or 5, 6, 7%, right? So by definition, there's got to be risk there, and I don't think that people, even at a basic level, understand. They get attached to the yield, right? Like anything, it's a shiny object. It's like a high dividend fund with a 7% yield. They love the yield and it looks good, but risk happens slowly and then all of a sudden. So I'd be curious to see when or if this unwinds at some point.
Yeah, that's another comment I saw just in reading about this stuff, is that this at the current scale that it's at, private credit hasn't gone through a full economic cycle. And like the floating rate debt is good from the perspective of the lender, because you can have less duration, so you're not going to be as interest rate sensitive. But from the perspective of the borrowers, who are already high risk borrowers, if rates keep going up, or just high rates in general, the fact that the debt is floating rate is not so good. Like, it makes the debt more expensive. And if they're already in a relatively precarious position, which is why they had to borrow this way, that just makes them riskier.
Yeah. What is the duration on these things? Obviously, there's going to be some variance, but
I'm not sure.
Because if these are shorter term loans, then presumably they're less risky than longer term.
The duration is going to be shorter, like much shorter than an aggregate bond fund for sure. I mean, just by the nature of it being floating rate.
Right.
But I think it is also shorter term.